Today's episode is sponsored by A3 Environmental, a Midwest-based environmental consultancy firm. With 19 years of experience and 25 scientists across the country, they have both the experience and the resources. A3 specializes in environmental due diligence. They are frequently hired by banks, private equity groups, property buyers and sellers, and M&A attorneys. Recently heard of a situation that A3 got involved in where a bank and a buyer had ordered an environmental report. And when the environmental report came back, the seller looked at it and he was somewhat suspect to what the findings were. And he actually hired A3 to come in and refute some of those findings with the other environmental firm. And at the end of the day, A3 was able to find some faulty findings and got the report thrown out and a clear to close for the seller. And they were able to get to the closing table. So they've really got the right resources and the right people. So if your acquisition is in the industrial space, automotive, or dry cleaning or plating, and the deal includes tanks or tubs, vats, drums, silos, or storage of any sort of hazardous chemicals, you'll definitely want A3 on your M&A team. Their motto is A3 Environmental Consulting. Buy assets, not liabilities. Hope you enjoyed today's episode.
Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Dominic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Dominic Rinaldi.
Did you know that for SBA acquisition loans, the banks require a third-party independent appraisal after they approve and underwrite the deal? Even though a bank's underwriting department may approve a loan, the SBA requires that the bank obtain a third-party business appraisal from an accredited firm to validate the purchase price that has been agreed to between the buyer and the seller. Today, we are being joined by Steve Mize, a founding partner at GCF Valuation. As an accredited senior appraiser for over 20 years, Steve has been valuing small and mid-sized businesses across all industries. Steve is also experienced in litigation support and responsible for all projects requiring expert witness testimony related to business valuations. Having worked with GCF Valuations over the years, I can tell you they are an outstanding firm. Steve, welcome to M&A Unplugged.
Well, I appreciate it, Dominic. Thanks for having me.
So, Steve, a couple of weeks ago, I had a chance to interview your brother, Darren, and on the show, we talked about valuations, from a buyer's and seller's perspective. And today, I'm hoping that we can really dive in and take it from the bank and lender's perspective. But before we do that, please provide M&A Unplugged community a quick backgrounder on yourself and the firm, and then we'll dive into this meaty topic.
Sure, sounds good. GCF Valuation goes back quite a long ways. We first started out as Gulf Coast Financial, which a lot of the listeners probably know us as. I actually started the firm in 1997 while I was still in college. And Darren, my brother and now business partner, kind of helped me early on. And we decided, hey, if we can get this thing up and running, let's go 50-50 in on it. And he kind of paid the bills and consulted along the way for the first couple of years. I kind of ran with the business. And then once we had enough clients, we were able to go full force, just he and I. And slowly, over the course of 6, 7, 8, 9 years, we would add on 1 or 2 employees at a time. We dabbled in a few different markets, including M&A, estate tax, and litigation. And then we kind of fell into the SBA loan side of our business today. At a random conference, someone came up to us and asked us if we would do it. We decided, yes, let's get into this market. We were the first and only business appraiser in the SBA market for probably 10 years until they started requiring the valuations. And then now there's a ton of competition out there, but we're still the first and foremost when it comes to business valuation and SBA. And we have a strong family-oriented firm. We're still considered a small business, and we still, kind of dabble in a few different industries. But the SBA side represents probably 50% of our business at the moment.
Wow. When was it, Steve, that they started requiring third-party independent appraisals?
It was actually just after the recession, the Great Recession, 2008, 2009. Loans started to really suffer. As we all know it, anyone in the M&A business, no one was making any decisions at all. 2008, 2009, and into 2010, business was kind of set on the back burner. So I believe they actually started the requirement in 2009.
Got it. Yeah, I remember we actually made our way through 2008 pretty well as an M&A firm. But in February of 2009, the SBA came out with a rules change around how they were going to treat goodwill, the fact that they weren't going to recognize it. And that put a screeching halt to everything.
That's exactly when the rules kind of started to get relatively strong. And we were asked by the SBA once, that was probably a 6-month period where they just wouldn't recognize goodwill at all. There was a lot of backlash in the community, in the financing and the M&A community. And we were one of the ones that kind of stepped up and said, listen, guys, goodwill is an asset. And in most cases, it's the most valuable asset in an M&A transaction. So we were able to help write what they call the standard operating procedures for the SBA. It was myself and another colleague, a gentleman by the name of Scott Gebhardt. We together worked with a few people with the SBA to help rewrite the SBA's standard operating procedures for business valuation. So again, this goes back quite a long ways.
Yeah, I know your firm has been integral in how the SBA views third-party valuations and some of the rules and regulations. And that's great work because, to all of a sudden unrecognized goodwill in a transaction, you couldn't finance anything because every business has goodwill, as you very well know, right? Or it should at least.
Yeah. And not only that is, I always ask lenders, would you rather lend on a manufacturing company with 90% of the value in their assets and with high customer concentration, low return on assets, high capital expenditures and possibly working capital expenditures and working capital requirements and more of a reliance on that equipment? Or would you rather lend to a service or tech-oriented company with customers across the board, high return on assets, relatively low overhead, low capital expenditures, working capital requirements? And all of them say, I would rather lend to scenario number 2. It's just, I would say within the last 10 years, most banks still kind of relied upon collateral. And it was collateral-based funding. And the SBA is just not that. It is, the majority of the value we see is goodwill. And the majority of these baby boomers that are now retiring have service-based businesses that need financing above and beyond the value of their tangible assets. Absolutely.
So, Steve, like I had mentioned earlier, your brother Darren was on a couple of weeks ago. We talked about valuations from a buyer's and seller's perspective. And, when we work with buyers in our M&A practice, we try to educate them on what to expect in the process if they're going to be going for an SBA loan. And just as a reminder to everybody in the M&A Unplugged community, SBA loans are for, loan values $5 million or less. And so one of the things that we tell them is, listen, you could go through the bank, you could go through underwriting, you could get your deal approved, but there's a process on the back end that the bank has to follow to get a third-party independent appraisal. And so you can't be bringing some crazy valuation to the table because there's this check and balance on the back end. I'm shortening that, and there's a lot more involved, but I'm hoping you could sort of bring the M&A Unplugged community through the process, what the thinking is, and then how you interact with the banks and what the requirements are.
Sure. So typically, the SOP requires that the bank engage the appraiser directly. Very similar to real estate, just like if you're going to buy a house, the lender is not going to allow you to use your own appraisal. So they actually have to order the appraisal. And that's usually within about a month of closing. They have already gone through the initial due diligence phase. The business development officer or salesperson for the bank has kind of started that process, information gathering, due diligence. Typically, it's 75% of the deals have already been underwritten by the time they get to us. Then once the bank says, okay, this is a deal that we can do, this fits in our box of reality, let's now engage GCF to do the valuation. And that's when it happens. So for us, it's a very similar process of that the underwriter takes. I always tell the underwriters, hey, we're just a second set of eyes for the due diligence side of things. We ask a lot of the questions that they possibly will miss. We ask a lot of the questions that actually, sometimes the salespeople or brokers, buyers and sellers may not want us to ask. We go into a little bit more detail in regards to what makes this company more or less valuable. So our process takes anywhere from, call it 7 to 12 days from beginning to end. We obtain the information. A lot of it's the same information that the underwriters are using to underwrite the deal. So I'll just throw out a few things like, 3 to 5 years of tax returns, interim statements, maybe a business plan and projections, any non-recurring expenses, what we all know as add backs, any type of contract or intangible asset or liability that would impact the value of the company. These are things that we look for up front. Once we get through that initial phase of information gathering, we start putting together a list of questions. And we start from a financial aspect. We'll spread the financial statements and start writing down our questions about the financials. We'll then do some research on the industry and the economy, whether it's local or national, and then write questions down about that. We'll pull some comps. We'll run a few different projections. Then from there, put together what we feel is a list of questions that we feel that has impact on the value. I always say to our analysts, I always tell them, when writing the report, never tell the underwriter, never tell the client what they can see on paper. Yes, I see a spreadsheet, and that spreadsheet tells me that revenue is increasing 10% each year, or cost of sales have decreased 15% per year. But we want to know why, and give us detail, not just more advertising or market trends have been good. Let's kind of figure that out a little bit. Same thing with things like customer concentration. And that's a big area of marketability or lack thereof for business valuation. And I don't want to know that I just see there's a 30% customer concentration. Let's dive into that customer a little bit more and have subset questions, at least 2, 3, or 4 different questions around that customer concentration. So business valuation kind of dives a little bit more deep than underwriting does. And then we essentially write a report and tell them about it. And I'd say roughly 7, 8, 9, 10 days later, we would give them a report. Let's say that the value is above the purchase price. They say, okay, looks good. If there is a shortfall, we address the shortfall. We then put it in draft form and say, okay, what are we missing?
All right. So I want to come back to the shortfall because we've had to deal with some of those situations. But before we get off of the process, during this time, is your team only dealing with the underwriter, or might you also be conversing with the actual buyer of the business and maybe even the seller? Or is it solely just working with the bank and everything goes through them?
Yeah, we actually will always make the borrower the first person of contact. Yes, we do talk with the underwriter. We get their opinion on the deal, on the business in general, just so we don't have to fly blind going into the deal. So we try to learn as much about the business as possible before talking to the buyer and or then the seller. A few things. A lot of people ask, why do you talk to the buyer? Well, the buyer, in our opinion, is probably going to be the most unbiased person. Other than the underwriter, the buyer is going to be typically the most unbiased person. So we're always going to get his or her opinion first. Then, if our questions can't be answered by either the buyer or the lender, by that time, we then set up conference calls with the seller, and we'll get the buyer and seller on the phone, or the seller's representation, in this case would be the broker, get them on the phone. So in a nutshell, we will try to talk to all parties involved. Some of our competition, they'll rely upon questionnaires and just kind of a blanket or boilerplate questionnaire. We don't. We feel that every business is a little bit different, and the questions are going to always be specific to that business that's being valued. So yeah, the buyer is the first point of contact.
Got it. And ultimately, the buyer is paying for it, right? Even though the bank orders it, it's a line item on the closing statement that the buyer has to pay for this third party valuation. So it is for their benefit.
Yeah, it's just like title fees. It's
right.
It's environmental reports. It's just like any other closing costs. It's just included in that. The buyer is paying for it. In the end, it's the bank's report. The bank is engaging us. The bank is paying us directly, even though the buyer is paying those fees. The bank is paying us, and the bank essentially owns that report.
Yeah, understood. So this valuation is because the bank orders it and because there are SBA regulations tied to this. Is the valuation process any different than if a buyer had come to you directly or a seller had come to you directly and said, I want to get my business appraised? Or is it the exact same process that you would follow?
Great question. And actually, it is the same process that we would follow. I think the biggest area that we see that could be different would be the definition of the value and the scope limitations in the report. So for instance, and if we're going to be engaged directly by a seller, and the seller provides us with the financial statements, let's say that they only are willing to give us an internal set of financial statements. They're not willing to give up their tax returns. Obviously, from an SBA side, the SBA requires tax returns. We're going to get to that in a second. But the second scenario here is adjustments, cash flow adjustments. Let's say we're doing a valuation for the seller, and the seller presents 20 different line items of personal items that are buried in the financial statements. At that point, it becomes more of a due diligence, or what CPAs will call agreed upon procedures. And let's say they don't want to pay to have those add backs verified by a CPA. Then at that point, we will put an assumption in the valuation that these are correct. We have not verified them. And if it ever does get to a financial institution or a government entity, then they would need to be verified. That's the biggest difference that we see. From an SBA side, typically tax returns are preferred. If there's a difference between, let's say, cash and accrual, then at that point we'll want to reconcile the tax-based cash returns with the accrual-based internals or CPA compiled. And then also add backs or cash flow adjustments will need to be verified, reasonably verified. Sometimes if there's 2, 3, or 4 add backs, we can hop in and verify those, no problem. But if it becomes more of an agreed upon procedures report, then we'll most likely have to engage an outside CPA firm. So that's the methodology is the same. The process is the same. The evaluation reports look and feel the same. But I would say that the financial aspect of it is the only area of difference.
Okay. Just to follow up on that question, then let's take it from the bank's perspective. Having done this for many years, I know that every bank has their own approach to getting the free cash flow in a deal. And so some banks disallow some percentage of depreciation, for example, just arbitrarily. Some have a plug number that they always want to use for a replacement manager salary. And that number could be, different from bank to bank or deal to deal. Do you change your assumptions in your models based on what the bank is requiring, or do you take a generic approach to that independent of what the bank requires?
Yeah, we never let the bank dictate, what add backs or methodology that we're going to be using. We'll agree on certain things and say, yes, this is a realistic adjustment, or the bank may come back and say no, and here's why. And I may agree or disagree, but in the end, we're a third-party valuation firm. We're essentially allowed to use what we feel is most accurate. So in regards to depreciation, the majority of these, these small to mid-market businesses are going to be bought and sold by a level of EBITDA or seller's discretionary earnings. EBITDA is earnings before interest, depreciation, interest, taxes, amortization. So it's EBITDA. It's depreciation is added back. So we'll always add it back from a market approach. Meaning if we're going out looking for market multiples and we're looking at multiples of EBITDA or SDE, that depreciation remains in there. However, if we're using an income approach, let's say a free cash flow approach, we'll add back depreciation. We're going to make adjustments for normal taxes, capital expenditure requirements, working capital requirements, and get to what we call a free cash flow. But getting back to the bank, we develop our own cash flow. The bank has their cash flow. And quite frankly, typically they're quite a bit different.
Yeah, that's been our experience. And every bank approaches this differently. So we find that we're constantly having to adjust our approach depending on which bank is looking to underwrite the deal. And, one bank may work perfectly for one type of deal and it may not for the next based on their assumptions. And so we're always having to sort of feel that out. But it's great to know that you're taking an approach that is, I don't want to say generic, but it is it's uniform.
Yeah, it's hypothetical buyer, hypothetical seller. So another question that's asked is, the scenario comes up all the time. I have this great buyer who already owns a company that is similar to the one that he or she is acquiring. They're going to be able to have some synergies between the acquisition. They're going to be able to take down cost of goods a couple of points, eliminate top line management. They should be able to eliminate rent or a good majority of the facility expense. This is a great deal, for our buyer and the bank. But in the end, we still have to look at that business as a hypothetical buyer, hypothetical seller. We cannot make the assumption that every buyer is going to be a strategic buyer. So we would have to value that business as is, not eliminate some salary expense, not eliminate some cost of sales, not eliminate rent, and value that business as if 9 out of 10 buyers were to acquire it.
Yeah, we get that question all the time, Steve. Sellers coming to us saying, I think my typical buyer is going to be a strategic. They're not going to have these expenses. I want to value it without those expenses. And we've been conditioned over the years because we worked with your firm enough to know that, we can't eliminate a lot of those expenses because you're going to look at it differently.
There are a few industries that you will make the assumption that the typical buyer is strategic. Most of the time, they're books of business. So you'll see it in insurance, property and casualty insurance. You'll see it in CPA firms, not a ton in CPA, but a good majority CPA because they essentially buy the book of business. And then obviously investment advisory, again, you're simply buying that book of business. So in that particular case, those are 3 instances where you can make the assumption that the normal buyer is going to be another person or another company who owns a similar business.
Got it. So let's go back to, you started to mention this earlier. We've hit this situation a number of times over the years where buyer and seller have agreed to a price. It goes through underwriting. The bank's good with it. Your firm does the third-party independent appraisal, and it comes out less than what the parties have agreed to. What happens at that point in time?
So I will say that probably 10%, maybe even 15% of all the businesses we value for SBA do come in under purchase price. And there's a few reasons why. First reason is, let's say it's a partner buyout and it's kind of a disgruntled buyout where the partner being bought out is simply taking cash from the business, doesn't really work there, but is taking distributions year after year. At that point, the buying partner is willing to pay above and beyond what the business is worth just to get that partner out. We see that quite a bit. The second reason is a strategic acquisition, what we just talked about. We see that quite a bit. And then third, sometimes the business is just plain overpriced. We see a lot of times when there's not a broker, that's when you see the business is overpriced, and they may be selling it to an employee. They may be selling it to a competitor. or someone who just doesn't know how to price businesses. So it does happen. Now, once we come to a value below the purchase price, typically what we do is put it in draft form and we supply the underwriter with the valuation and then essentially just go over it and say, what are we missing? We always want everyone to cross-check cash flow. That's the first thing that we do. The second thing, are there certain assumptions that we're missing? Let's just say it's just overpriced at that point. It's really the underwriter's decision and the bank's decision, because the SBA in the SOPs, the SOP states that the value of the business must support the loan amount. It has nothing to do with the purchase price. It specifically says in the SOP, value must support the loan amount. And that's just the SBA loan. That's not even considering a seller note or a conventional note. It's simply the SBA loan. So if the lender has an internal requirement that says the value must support the purchase price, then at that point, the lender has to go back and ask the buyer and the seller to renegotiate. However, if let's say the loan is fine, you've got 20% equity injection, you have another 10% seller financing, and the value more than enough supports the loan amount. Under delegated authority, if they're a 7A lender, then they do have the ability to close that loan.
Got it. And what you said, I think is really important. Is the first step is you go back to all the parties and say, look, did we miss something here? Because you're coming in undervalue. And I know in the times when that's happened with us, it's very much a collaborative process. You get everybody involved, and it's been great to work through that with your firm, because we roll up our sleeves. We try to figure out if we miss something along the way, and if there's a correction that might, bridge the gap that we have. So,
and I would say 99%, and I am not kidding on that, 99% of the deals that we work on will get renegotiated and everybody's happy. Again, it's usually, if it's a $2 million deal, maybe it comes in at 185 or 19 or something like that. It's not a huge, discrepancy in value. There's only been a handful of times when it's a massive strategic acquisition and there's some intangible assets that they want to pay for, but really don't have a whole lot of value at the moment. And maybe it's a $2 million deal and we come in at $700,000-$800,000 or something like that. That's been the only times when they may not get renegotiated. But like I said, 99% certainly get renegotiated.
Makes sense. So Steve, are there any changes that you're aware of coming down in 2020 or beyond that is going to impact the way that this process works today with the banks and the SBA?
Yeah, we try to stay in tune with legislation, with our governing body in this industry is the NAGL, National Association of Guaranteeing Government Lenders. And we try to stay relatively dialed into to what's being talked about. The process hasn't changed much. There's been a few terminology changes over the past years for SBA's SOPs. They make changes a couple of times, once or twice a year. They haven't really made any changes to this point. And quite frankly, I think if it's not broke, don't fix it kind of mentality, I believe, just because a lot is being done right now. Possibly we'll see a slowdown here. I think last year the SBA lending was down 10% or so. We'll see what happens this year. But in the end, I don't see any major changes in the process in regards to business acquisition.
So, Steve, we're going to get ready to start wrapping up. What advice would you offer up to the M&A Unplugged community, buyers and sellers and advisors around this process so that, when they get into it and they're looking to sell or acquire, it goes as smoothly as possible?
Yeah, that's a great question. I would say to the advisors, start the relationship early. I see the most successful brokers and advisors out there, they're not focused on selling a company for their client. What they're doing is they get in early, they create that relationship, create that foundation. They may help them value that business early and say, okay, what can we do to help you with this exit strategy in 1, 2, 3 years down the road? How can we increase the value of this company where all of us will benefit from it? So that's the first thing. I see the most successful advisors out there start early with their clients. Now, in that process, when we do get involved, I always tell them you want to focus on a few different metrics. One is going to be cash flow, obviously. A lot of people say, my industry sells for 1 times revenue or 2 times revenue or whatever it may be. Value is a cash flow driven metric. The definition of value is based upon the discounted value of future cash flows. Cash flow is king. So first thing I say is clean up your financial statements. If you've got a lot of personal expenses, if you've got a lot of non-recurring things, if you really have done a good job of limiting your tax liability, that's good from a tax standpoint, but it's bad from a value standpoint. The less add backs or less cash flow adjustments that you have, the more credible your financial statements are going to be. There's going to be less likely of concern on the financial side of things. So, the first thing I say, and we've done studies in our company where, you look at 100 different firms, one where the add backs consist of Ebitda and officers' compensation, and then the others consist of Ebitda, officers' compensation, and then multiple other line items. The more add backs that you have, the lower the multiple is going to be, not from the valuation aspect, but from the buyer's perspective. So when we see purchase price multiples, the higher the amount of add backs, the lower the multiple. So first thing I always say, clean up the financial statements. Second thing, diversify, whether it's customer concentration, supplier concentration, product concentration. You want to do everything you can to diversify that business. Everyone looks at customer concentration, number one. And yes, I would say that's the most important. But if you rely on one product, that's typically not a good sign. And it may take you a few years to generate new SKUs or new products to diversify your sales funnel. But that's a big item. And obviously a supply aspect. Who is your supplier? I would make sure that you have multiple suppliers just in case something happens to that person. Last thing is reliance upon an owner or key employee. You'll notice when you look at multiples of cash flow for professional practices like doctors, dentists, those guys, they're super low. Those multiples are 1.5, 2 times discretionary earnings. And the reason why is because of personal goodwill. It's a heavy reliance upon the owner. A buddy of mine was fortunate just to sell his company, or he's got a letter of intent, a much larger company, about 80 million in revenue. He, about 6 years ago, decided to step away and hire a few more people to kind of run the day-to-day operations. And it took a while. It took 4 or 5 years. But he essentially has been able to step away from the day-to-day management. And the private equity group that has the LOI on this company recognized that and paid, I would say, a good 25%, maybe 35% more than as if he were an owner operator. So certainly reducing the reliance upon the owner, reducing reliance upon any key salespeople or key employees. So those 3 items, I think, are going to be my advice to sellers prior to getting ready to sell and possibly use SBA financing down the road.
That's awesome advice. That's great. Steve, it's been such a pleasure having you here. And as I mentioned earlier, having worked with your firm over the years, you guys are tremendous. You do great work. If people in the audience wanted to get in touch with you, how could they best reach you?
Best way to reach me is via email. I travel quite a bit. We have a few different offices, and I kind of travel between all the offices. So email is typically the best, and it's going to be my first initial last name. So it's SMIZE, and then it's at 𝐃value.com, the letter G, and then value, VALUE. So SMIZE at 𝐃value.com. That's the best way to reach me, and I usually will get back to people within a few hours. So I'm very accessible.
Awesome. Thanks, Steve. Really appreciate you being here.
Appreciate it, Dominic. I enjoyed it.
So M&A Unplugged community, I'm not going to do a big recap here because the messages that Steve delivered at the end, especially the recap, you've heard time and time again. Clean up your financials. The cleaner they are, the higher your multiple. The more discretionary expenses you load in there, the more you pack in, your multiple is going to go down. And in many cases, some of those add backs can't even be considered. Diversify your business, diversify your clients, your vendors. And then if the business relies on you as an owner or a key employee, your value is going to go down in some cases so dramatically that it'll require an earnout and a multiple that probably isn't really acceptable. It's great advice. Really appreciated Steve visiting with us today. All of today's information will be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit our website at sunacquisitions.com or feel free to reach out to me at drinaldi@sunacquisitions.com. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.